Have you ever watched a stock suddenly surge higher, seemingly out of nowhere, while wondering how some traders always manage to be positioned perfectly before these explosive moves? What if I told you these market movements aren't random at all, but rather carefully orchestrated campaigns that leave behind subtle but detectable footprints for those who know where to look? The truth is, while most retail investors are frantically reacting to headlines and chasing momentum, the smart money, what Richard Wyckoff called the composite man, is methodically executing a time-tested strategy that has remained largely unchanged for over a century. Has this ever happened to you? You finally give up on a stock after months of sideways movement, only to watch it explode higher just days after you sell. What we perceive as chaotic market behavior is actually a logical entity that consistently advertises its future intentions through the interplay of supply and demand. The average investor, driven by emotion, buys on hope and sells on fear, perpetually one step behind the true movements of the financial tide. But trained observers can recognize the deliberate footprints of institutional money as it quietly prepares the ground for significant advances. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. The foundation of Wyckoff's entire method rests upon the first and most simple law of markets, the law of supply and demand. This principle is as old as commerce itself, yet its application to stock market analysis remains largely misunderstood or ignored by the average trader. Stay with me until the end, because understanding this principle alone could transform your entire approach to market analysis. Prices rise only when demand exceeds supply, and they decline only when supply is greater than demand. When these two forces are in equilibrium, prices move sideways in a narrow range. Every fluctuation, from the smallest tick to the grandest multi-year bull market, is a direct expression of this continuous battle between buyers and sellers. What you're about to discover might surprise you. The thousands of influences that most people use as a basis for their trading decisions. News, earnings reports, dividend rates, political events, and personal opinions are all concentrated and boiled down into one simple metric: the combined effect of buying and selling pressure. This combined effect is all that matters, and it is faithfully recorded on price charts for those who understand how to read them. To predict a future uptrend, then, is to accomplish one critical thing: to identify through logical analysis of price and volume the exact point at which demand is quietly but decisively overpowering supply, long before the general public becomes aware of the shift. And this identification process begins with recognizing the 7 distinct signs of accumulation that Wyckoff discovered through decades of meticulous market study. If you're serious about mastering the markets, hit subscribe now. Join our community of traders who understand what's really happening behind the price action. This process of accumulation is not random or accidental. Behind every significant market move lies what Wyckoff called the composite man, a concept that represents the collective actions of the most informed minds in the market. Think of the composite man as the amalgamation of large operators, institutional investors, insiders, and skilled financial interests who conduct deliberate, well-planned campaigns to accumulate stocks. The revelation here is that these campaigns follow predictable patterns that have remained unchanged for over a century. The composite man doesn't act impulsively or emotionally. He orchestrates a methodical journey of accumulation that can span weeks, months, or even years. What's fascinating about this hidden truth is that these informed players operate under a cloak of pessimism. They're not buying during market euphoria when everyone is optimistic. Instead, They're quietly accumulating their positions when public sentiment is at its worst, when headlines are grim, when analysts are downgrading, and when the average investor has given up hope. This mindset transformation is critical to understand. The composite man sees opportunity precisely when others see disaster. The first concrete sign that this behind-the-scenes accumulation is taking place appears in what Wyckoff identified as the selling climax. This is where our journey into true market understanding begins. The selling climax represents the dramatic stopping of a prior downtrend, a decisive moment when the composite man makes his first major move. Picture this scenario. After a stock has been declining for a prolonged period, public sentiment becomes overwhelmingly bearish. Those who bought at higher prices are discouraged and fearful. As the decline continues, this fear often transforms into panic, and the last of the weak holders capitulate, throwing their shares onto the market without regard to price in a final, desperate attempt to escape further losses. This is the precise moment the composite man has been patiently waiting for. When others are making emotional decisions to abandon ship, he steps in with immense buying power to meet this deluge of panicked selling. The impact of this decisive action leaves distinct footprints on your charts that you can learn to recognize. On a vertical chart, you'll notice several distinct features during a selling climax. First, there's a precipitous drop in price, often ending in a trading day with an exceptionally wide price spread from high to low. Second, this price drop is accompanied by abnormally large or climactic volume, the result of both massive public selling and massive institutional buying absorbing it. Third, and perhaps most revealing, after plunging to its extreme low, the stock will often rally strongly to close well off the bottom. This shows the buying power was not only sufficient to absorb all the selling, but strong enough to reverse the immediate trend. Now I want to go even deeper into how this initial signal of accumulation is confirmed by subsequent market action, and what happens after this critical turning point that solidifies the composite man's position. If you're seeing these patterns in stocks you follow right now, write in the comments, "I see the footprints," so I know you're connecting these concepts to your real-world trading. After the selling climax has occurred and shaken out the weak holders, the market typically experiences what Wyckoff called an automatic rally. This rally is caused by the sudden vacuum of selling pressure. With the public having exhausted its supply of stock in the climax, even a moderate amount of continued institutional buying can cause the price to rebound sharply. But this rally isn't the confirmation we're looking for. It's what happens next that reveals the composite man's true intentions. The stock will inevitably drift back down to test the area of the recent selling climax low. This moment represents a critical revelation in the journey of price discovery. It's the market's way of asking, was that truly the bottom, or is there more selling pressure to come? The answer lies not in the price action alone, but in the relationship between price and volume. This is where the hidden truth becomes visible to those with trained eyes. If the heavy selling that caused the climax is truly exhausted, then this secondary test should occur on significantly diminished volume. The price may approach the prior low, but the volume will be a fraction of what it was during the climax. This dramatic contrast in behavior unveils something profound about market psychology. It demonstrates conclusively that the intense selling pressure has been exhausted. There is little or no stock being pressed for sale at these low levels. The composite man, having absorbed the panic selling, now finds that the supply has dried up. He may deliberately withdraw his bids to see what the stock will do if left to itself, and the resulting low volume and lack of downward progress confirm that the sellers are gone. This is where patience transforms into opportunity for the astute observer. With the boundaries of the trading range now established, the low of the selling climax as support and the high of the automatic rally as resistance, the lengthy process of accumulation begins in earnest. The stock enters its third phase, oscillating within this range as the composite man methodically absorbs shares. To the uninformed observer, this sideways movement appears lifeless and uninteresting. Many investors lose interest during this phase, missing the subtle but powerful signals that indicate a future uptrend is being prepared behind the scenes. But for those who understand Wyckoff's method, this is where the most crucial evidence is revealed. Subscribe to the channel for more deep dives into professional trading strategies that the mainstream never talks about. Your trading journey deserves this level of insight. The third sign of accumulation is the gradual drying up of supply, which manifests through a particular volume signature. Volume should tend to expand on the rallies from the support level to the resistance level, and it should noticeably contract on the reactions from the resistance back down to support. This pattern shows increasing enthusiasm on advances and decreasing selling pressure on declines. The consistently shrinking volume on each successive decline within the range is especially significant. It indicates that fewer and fewer shares are being offered for sale on each dip, direct evidence that the floating supply is being absorbed. Sellers are becoming scarce while buyers are becoming more prevalent. As we continue to explore the Composite Man's campaign, we'll see how these early signs of accumulation evolve into even more powerful indicators of an impending uptrend. If you've noticed this pattern of decreasing volume on dips in a stock you're watching, drop "supply drying up" in the comments section and let me know you're tracking these subtle market signals. As the long process of accumulation nears its completion, the composite man often employs one final, masterful maneuver to ensure the path is clear for the coming markup phase. This fourth sign is what Wyckoff colorfully called the spring or shakeout, a strategic deception that represents the culmination of months of careful preparation. Imagine you've been observing a stock that's been trading sideways for months, showing all the classic signs of accumulation we've discussed. The support level has been tested multiple times and has held firm. Most investors and traders have come to trust this support as reliable. This psychological comfort zone is exactly what the composite man exploits in his final act of manipulation. The spring is a sharp and usually brief price movement that penetrates the established support level of the trading range, only to quickly reverse and climb back into the range. This calculated move serves multiple strategic purposes in the composite man's grand design. First, it creates the illusion of weakness, misleading the public and any remaining hesitant holders. When support is broken, conventional wisdom suggests further decline is imminent, prompting the last nervous investors to abandon their positions. The hidden truth behind this deceptive move reveals the composite man's brilliance. By driving prices below recognized support, he triggers predictably placed stop-loss orders clustering just below that level. This forced selling provides one final opportunity to acquire shares at advantageous prices, essentially mopping up the last available supply before the true upward journey begins. But the most powerful revelation of the spring lies in what happens immediately after the support breach. If the accumulation campaign has been successful, the break below support will not unleash a cascade of selling. Instead, the price rapidly reverses and climbs back into the trading range, often in just a few days or even a single session. This swift recovery is one of the most powerful and reliable buying signals in Wyckoff's entire methodology. It announces that the last of the sellers have been eliminated and the track is now clear for advancement. Following this successful spring, the fifth sign emerges, clear and unmistakable signs of strength. The character of the price movement undergoes a dramatic transformation. Instead of the labored low-volume rallies seen earlier in the accumulation process, the stock now produces pronounced, powerful advances with widening price spread and noticeable expansion in volume. These movements demonstrate that demand has decisively seized control of the auction process. After one or more of these signs of strength have established the new bullish character, the stock approaches the upper boundary of its long-standing trading range. This level of resistance, which has turned back all previous rallies, is what Wyckoff poetically called the creek, the decisive move. Above this resistance, the jump across the creek is not a timid or hesitant breakout. It's characterized by expanded price range and significant sustained volume, showing that demand is now fully assertive and capable of absorbing any supply that appears. This moment represents the profound transformation from invisible accumulation to visible markup, where the patient investor's foresight is finally rewarded. If you've ever watched a stock break below support, only to reverse strongly, higher the next day, type "I've seen the spring" in the comments. You might have witnessed this powerful Wyckoff signal without even realizing it. While buying during a spring offers the greatest potential reward due to the lower price, it also carries inherent risk if we misinterpret the move. The jump across the creek, however, is a confirmatory signal, the market's unambiguous announcement that the period of quiet preparation is over. But the journey doesn't end with this initial breakout. Very often, after the stock has made its decisive move above resistance, we observe another subtle yet significant price action that Wyckoff called the backup to the edge of the creek. This small pullback or sideways consolidation represents a final test of the newly established support level. What was once resistance has now transformed into support, a fundamental principle of market structure. This backup provides a powerful revelation about the stock's true character. If the prior accumulation process was genuine and thorough, this retest should occur on diminishing volume, once again confirming that supply has been exhausted, but now at these new higher levels. This pattern creates what many traders consider the ideal entry opportunity, a low-risk point to initiate or add to a long position with a clearly defined stop-loss just below the former resistance line. The backup to the edge of the creek represents the market's final verification that the path of least resistance has indeed shifted from sideways to upward. It's the last checkpoint before the true markup phase begins in earnest. The psychological shift here is profound. What was once a ceiling has now become a floor, fundamentally altering the mindset of market participants. Now I want to introduce you to another powerful dimension of Wyckoff's methodology that runs parallel to these sequential signs. Throughout the entire process of accumulation and at the beginning of the markup phase, Wyckoff emphasized the importance of observing the stock's comparative strength relative to the general market. This sixth sign provides perhaps the most compelling evidence of behind-the-scenes accumulation by informed interests. A stock that is being genuinely accumulated will exhibit distinct characteristics during broad market movements that set it apart from the average issue. While still consolidating within its trading range, it will often show stubborn resistance to declines. When the general market experiences a sharp reaction, the stock under accumulation will frequently decline by a smaller percentage than the average. At times, it may hold perfectly firm or even rally slightly against the tide. This unusual behavior reveals something profound about the stock's ownership structure. While other stocks are being sold freely, there is a persistent and powerful demand for this particular stock that is quietly absorbing any offerings and preventing it from falling. It's as if an invisible hand is supporting the price, refusing to let it participate fully in the market's weakness. Conversely, on rallies in the general market, the stock under accumulation will often respond with greater vigor and speed than the average, demonstrating its eagerness to advance now that the general market selling pressure has been lifted. If you've noticed a stock in your watch list that seems to resist market downturns more than others, drop relative strength in the comments. You may have unknowingly identified a stock that's under professional accumulation. This quality of superior performance becomes especially illuminating after the stock has completed its jump across the creek. Now in strong hands and free of any significant overhead supply, the stock will often lead the market's advances and show remarkable resilience during general market corrections. This differential strength isn't coincidental. It's the direct result of the ownership transformation that has taken place. Enduring accumulation. James R. Keane, the famous market operator whom Wyckoff studied intensively, once shared a revelation that captures the essence of this principle. Watch the stock that shows strong resistance to pressure when the market is weak and buy those stocks for all you are worth. This simple yet profound insight offers us a powerful filter to identify the specific stocks most likely to become the strongest leaders in any coming uptrend. By focusing our capital on these issues that demonstrate superior strength, we ensure our funds are employed in the vehicles most likely to move the soonest, the fastest, and the farthest. This selective approach represents a fundamental mindset shift from how most investors operate. Rather than spreading capital across many stocks or following the crowd into popular names, the Wyckoff method directs us to concentrate on those select few issues that have already proven their exceptional character through their relative performance. Now I want to explore the seventh and final sign, the logical culmination of all the preceding evidence. After successfully navigating through the accumulation phase, springing the last weak holders, jumping across the creek, and demonstrating superior comparative strength, the stock finally establishes what Wyckoff described as a clear, sustained, and unmistakable uptrend. An uptrend, in its simplest definition, is a persistent series of higher tops and higher bottoms, a staircase-like progression that visually confirms demand is in continuous control of the stock. After completing the jump across the creek and a successful backup to the edge, the stock begins to make steady upward progress. Each rally pushes the price to a new high, and each subsequent reaction or consolidation period stops at a higher level than the one that preceded it. What makes this journey so reliable is that the character of the volume continues to confirm this trend. According to the law of effort versus result, volume should be strong and expand on advances, showing enthusiasm and power on the buying side, and that the effort is producing a positive result. Conversely, volume should noticeably contract on reactions, indicating that selling is light and represents simple, healthy profit-taking rather than distribution by large interests. This final sign represents the transformation from invisible accumulation to visible markup, the culmination of the composite man's entire preparatory campaign. His patient, methodical work is complete, and he now allows the visible uptrend to attract further public participation, creating additional buying pressure that helps carry the price toward his ultimate objective. If you're currently tracking a stock that's forming higher lows and higher highs after a period of sideways movement, type staircase pattern in the comments. You might be witnessing the final confirmation sign of Wyckoff accumulation. The Wyckoff analyst, who has correctly identified the preceding 6 signs, can now participate in this markup phase with a high degree of confidence. But even as the uptrend develops, volume analysis continues to provide crucial insights into the health and sustainability of the move. This deeper layer of understanding transforms how you interpret market action, allowing you to distinguish between genuine strength and potential warning signs. In a healthy, sustainable uptrend, the volume signature follows a distinctive pattern that confirms demand remains firmly in control. Volume should expand noticeably during advances, creating what technical analysts call accumulation days. Sessions where institutional money is actively buying, showing enthusiasm and conviction on the buying side. This positive correlation between price and volume confirms that the effort, volume, is producing the appropriate result, price advance. The inverse relationship during reactions is equally revealing. As prices pull back or consolidate, volume should contract significantly, demonstrating that the selling is light and represents simple profit-taking rather than organized distribution. This diminished volume on declines tells us that despite the temporary pause in upward progress, there's no substantial change in the ownership structure. Strong hands are maintaining their positions, while weak hands are providing only minimal supply. This volume signature represents the invisible architecture supporting the price structure. Without this confirmation, even the most visually appealing uptrend could be built on a fragile foundation, vulnerable to sudden collapse. The harmony between price and volume provides the reassurance that what we're seeing is authentic market strength rather than a deceptive facade. What we're witnessing during this phase is the culmination of the entire accumulation campaign, the moment where patience is rewarded and foresight is validated. The composite man's preparatory work is now complete. The lengthy, often tedious process of absorbing available supply has created the necessary conditions for the stock to advance with minimal resistance. Now, in a fascinating reversal of market psychology, the visible uptrend begins to attract public participation. The same investors who were eager to sell at the bottom are now eager to buy as they witness the stock's consistent strength. This new wave of buying creates additional demand that helps carry the price toward the composite man's ultimate objective. This journey from invisible accumulation to visible markup represents one of the most profound transformations in market dynamics. What begins as a deliberate campaign conducted in secrecy by the most informed minds in the market eventually blossoms into a public trend that captures widespread attention. The discerning investor who recognizes this process in its early stages gains an invaluable edge. The ability to position themselves alongside the smart money rather than being manipulated by it. If you're realizing how the volume patterns you've observed in the market suddenly make more sense in this context, type volume truth in the comments. I'd love to hear if this perspective is changing how you view chart patterns. Now that we understand how to identify and participate in the markup phase that follows accumulation, it's crucial to recognize that this uptrend won't continue indefinitely. The Wyckoff analyst, who has correctly identified all the preceding signs and is now riding the uptrend, must remain vigilant, managing their position until they see the first definitive signs that the market's character is changing once again. Just as accumulation represents a transfer of ownership from weak to strong hands, distribution represents the opposite, a methodical campaign by the composite man to transfer his holdings back to the public at higher prices. The skilled analyst manages their position by continuing to follow the clearly defined uptrend until they observe the first warning signals that supply is beginning to overpower demand. These signals often mirror the accumulation process in reverse, preliminary supply appearing on climactic volume, automatic reactions followed by secondary tests, and the establishment of a new trading range at higher levels. The market operates in this continuous cycle of accumulation, markup, distribution, and markdown, a rhythm that reflects the natural ebb and flow of human psychology as much as economic conditions. This cyclical perspective represents a profound shift in mindset for many traders and investors. Instead of viewing the market as a random series of price movements or reacting emotionally to news events, the Wyckoff analyst sees a logical, structured process unfolding over time. They understand that the same fundamental forces govern market behavior today as they did a century ago when Wyckoff was developing his methodology. The 7 signs of hidden accumulation we've explored aren't isolated signals to be mechanically checked off a list. They represent a logical sequence of events, a narrative that unfolds on the chart for the trained observer to recognize. Detecting this process is similar to piecing together evidence to solve a case. It requires patience, attention to detail, and the ability to integrate multiple pieces of information into a coherent whole. It starts with the climactic evidence that stops a long downtrend. It proceeds with forensic analysis of the subsequent trading range, searching for the subtle clues of the composite man's intentions. It involves recognizing his deceptive maneuvers and waiting for the final conclusive proof before committing capital. When all 7 signs align, the conclusion that a new uptrend is the most probable future outcome becomes not a matter of hope, but of reasoned deduction. This integrated approach transforms how we interact with the market. Rather than being at the mercy of price fluctuations, we become detectives reading the story the market is telling through its own actions. We learn to recognize the invisible hand of accumulated knowledge and capital as it quietly prepares the ground for significant advances long before they become obvious to the general public. The beauty of Wyckoff's methodology lies in its focus on observable facts rather than predictions or opinions. It doesn't require inside information or special access, just the ability to read the language of the market itself through price and volume analysis. If these concepts about market cycles and the continuous transfer of ownership between strong and weak hands are resonating with you, type "market detective" in the comments. I'd love to know if this perspective is changing how you view chart patterns and price movements. As we've journeyed through Wyckoff's 7 signs of hidden accumulation, I hope you've begun to see the markets through a new lens, one that reveals the deliberate campaigns of accumulation that precede every significant market advance. This method has stood the test of time for over a century because it's based on the unchanging principles of supply and demand and human psychology. What fascinates me most about Wyckoff's approach is that it doesn't require special tools, insider information, or complex indicators, just a trained eye to recognize the footprints that smart money leaves behind on price and volume charts. It's like having X-ray vision into the market's true structure, seeing beyond the noise of daily fluctuations to the underlying forces that actually drive price. If you found value in this deeper understanding of market mechanics, I'd truly appreciate your support with a like on this video. It helps others discover this content who might be struggling with the same market challenges you faced. And if you're ready to continue developing your market literacy, subscribe to the channel. We're building a community of thoughtful traders and investors who are committed to understanding the market's true language rather than following the crowd. Each week, we explore another dimension of professional trading psychology and technical analysis that you can apply immediately to your own trading. If you've made it all the way through this exploration of Wyckoff's methodology, type "I see the composite man" in the comments. I'd love to know who's on this journey of market mastery with me. There's a video right here that complements today's topic, showing these exact accumulation patterns in action on recent chart examples. Click and continue with me over there to see how these concepts apply in today's markets. I'll meet you in the next video.